The United States government called an emergency meeting on critical minerals just days after silver suffered a 41% collapse in less than 3 days. That is the story. That is the event. Because while Western traders were panic selling silver into a historic crash, buyers in Asia were still paying a huge premium for the same metal. So the real question is not whether silver crashed. It did. The real question is this: why was one side of the world dumping paper while the other side was quietly paying up for physical supply? That is where this gets dangerous for the mainstream narrative. Because if this were just a normal bubble popping, then demand should have vanished everywhere. The panic should have been universal. The bids should have disappeared. The premiums should have collapsed. But that is not what happened. What happened was stranger, more revealing and important. The paper market cracked. The physical market sent a different message. And by the time we get to the end of this, you are going to see why an emergency government meeting, an Asian premium, and a major bank's move into Singapore may all be pointing to the same thing. Silver did not drift lower. It got hit by a freight train. After running from around 30 in early 2025 to 121 by late January 2026, the metal finally snapped. Gold was also at extreme highs. Sentiment was euphoric. Speculators piled in. Momentum funds piled in. Retail traders chased candles. Overnight buying out of Asia kept lifting the market while the West woke up every morning feeling late to the move. It stopped being a steady bull market and turned into a stampede. And when a market becomes a stampede, it only needs one sharp trigger for the entire herd to reverse at once. That trigger came fast. A more hawkish policy outlook hit the market. The dollar firmed, risk appetite changed, and a market that had been running on momentum suddenly had to face gravity. What came next was not an orderly correction. It was liquidation. The kind of liquidation where price is no longer about value. It becomes about survival. Traders who were over-leveraged were not asking what silver was worth. They were asking what they had to sell right now to stay alive for one more session. Gold dropped hard first, but silver was where the real damage landed. Profit-taking started, then the selling fed on itself. One wave triggered another. Lower prices caused margin calls. Margin calls forced more selling. More selling caused new margin calls. Algorithms hit bids. Stops got run. Humans were too slow to react. By the time major Western desks were fully engaged, the market was already in freefall. Silver dropped 37% in a single day, then sank further into Monday, taking the total collapse from 121 to 72. 41% gone in less than 72 hours. That was not volatility. That was a financial car wreck. And then the weekend made it worse. Because once the market was already bleeding, margin requirements were raised. For anyone not trading futures, here is what that means in plain language. Imagine you bought a property with borrowed money. Then, in the middle of the panic, the lender calls and demands far more collateral by Monday morning. If you cannot produce it, the position gets taken from you. Now imagine that happening to thousands of traders all at once. That is how you turn a bad decline into a forced liquidation spiral. The market was already on fire. This poured fuel on it. Now here is where most coverage stops. They tell you silver crashed. They tell you leverage was too high. They tell you the market got frothy. All of that is true. But it is not the full story. Because while the West was staring at red screens, something else was happening on the other side of the world that did not fit the idea of a normal collapse at all. And this is where the chart that changes everything comes in. At the same time Western silver was imploding, Shanghai was showing a massive premium for physical silver. Let that sink in. The same metal, the same element, the same silver on the same periodic table. But in one market it was being dumped at panic prices, and in another market it was still commanding a much higher price. That gap was not tiny. It was enormous. Roughly $23 an ounce, or about 29%. In other words, while fear dominated Western paper trading, physical buyers in Asia were still willing to pay materially more. That should stop you cold. Because if silver demand had truly collapsed, why was anyone paying up for the physical metal? Why would serious money accept that premium unless the lower Western price was reflecting paper stress more than real-world supply and demand? This is the kind of divergence that tells you the headline price may not be telling the whole truth. The paper market can panic. The physical market has to deal with metal, delivery, and industrial need. And the premium was not some random one-day freak print. When you step back and look at the trend over the previous 12 months, the gap had exploded. Not by 10%, not by 50%, by more than 1,800%. That is not normal price discovery. That is the sound of two markets drifting farther apart. One market is trading leverage, positioning, and fear. The other is trading access, urgency, and physical scarcity. If you ignore that split, you are missing the most important part of the story. Then it got even more extreme. On the Shanghai Futures Exchange, silver contracts across the curve slammed into limit down conditions. Contract after contract froze. Trading rules kicked in. Circuit breakers did their job. The market was being restrained. But even there, once you converted those limit down levels into dollars, China's worst-case floor was still well above where Western silver was freely trading. Think about what that means. Their panic price was still far above our crash price. Their floor was above our fire sale. That is not a small discrepancy. That is a flashing warning light. And China did not sit there passively while this happened. Funds were suspended, traders were restricted, position limits were tightened, cooling measures hit the market. They moved to reduce speculation and slow the frenzy. But even after all of that, silver did not simply vanish. It found support. It rebounded off the lows. That matters because true dead markets do not bounce like that when real buyers are waiting underneath. Now ask the next obvious question. If Asian exchanges were already tightening conditions before the crash fully unfolded, who else saw stress building in this market before the rest of the world admitted it? Because someone clearly understood that precious metals were no longer just another chart on a screen. And that brings us to the move that makes this whole story harder to dismiss as coincidence. One of the biggest financial institutions on Earth shifted its precious metals focus towards Singapore. Not Manhattan, not a bigger commitment to old Western centers. Singapore, right next to the part of the world where physical demand has been strongest, where sovereign accumulation has been aggressive, and where the premium over Western prices has been impossible to ignore. Large institutions do not reposition major operations across the globe on instinct. They do it because their best people study the flows, study the incentives, and conclude that the center of gravity is moving. That is what makes this more than a silver crash story. It is a power shift story. It is about where price is discovered, where physical metal is wanted, and where the strategic importance of commodities is being taken most seriously. If capital, infrastructure, and decision-making are all moving east, while Western traders keep treating silver like just another speculative vehicle, then the next phase of this market may not look anything like the last one. And then came the emergency meeting. The United States scheduled a critical minerals gathering in Washington, with international delegations flying in, right in the middle of this chaos. Official language talked about strengthening and diversifying mineral supply chains. That sounds bland until you translate it. It means there is concern. It means existing supply chains are not secure enough. It means dependence on external sources has become uncomfortable. It means governments are no longer content to leave strategic materials entirely to the market. And silver belongs in that conversation whether the average investor realizes it or not. Most people still think silver means jewelry, coins, or old silverware in a drawer. That view is outdated. Silver is embedded in the modern economy at a much deeper level. Solar panels need it. Electric vehicles use it in critical electrical components. Semiconductors rely on it. Advanced communication systems use it. Defense technology uses it. Medical equipment uses it. Consumer electronics use it. Silver is not just decorative metal. It is industrial bloodstream material. That is why the supply picture matters so much. Industrial demand has been immense. A huge share of global silver demand is not sitting in vaults waiting to be resold. It is being consumed in products and systems. It gets dispersed. It gets used. It gets locked away in applications where recovery is difficult, slow, or uneconomic. At the same time, silver is not easy to ramp. Most of it is produced as a byproduct of mining for other metals. That means a much higher silver price does not instantly create a wave of new supply. New projects take years. This is where the emergency meeting becomes much more interesting. Because once governments realize a material is strategically essential and structurally constrained, they start thinking in a different way. They stop treating the market as a neutral mechanism and start treating the commodity as a national security issue. That can lead to stockpiling. It can lead to tighter alliances. It can lead to export restrictions, tax incentives, supply agreements, or direct state support for domestic production. None of those outcomes are guaranteed. But once the conversation moves into that room, the risk changes. And this is the broader context the crash cannot erase. The world has already been moving toward a more fragmented, competitive resource environment. Countries are no longer assuming that critical inputs will always be available on demand at the lowest global price. They are planning for scarcity, leverage, and control. Some governments have already moved aggressively to protect strategic supply and other minerals. So when Washington suddenly places critical minerals on an emergency agenda during a silver collapse, it is not irrational to ask whether silver is being viewed through that same lens. Now step back and look at the sequence. Silver peaks in a speculative frenzy. The market breaks violently. Paper prices implode. Shanghai keeps signaling a strong premium for physical metal. China tightens controls. Major financial infrastructure shifts toward Asia. And the United States convenes an emergency critical minerals meeting. If you line those events up one by one, the picture gets harder to dismiss. Not because every event proves the same conclusion by itself, but because together they point to stress in a market that may be far more strategic than most people think. Here is where another layer matters. A crash can clear excess without destroying the long-term case. Markets do this all the time. Overextended positioning gets washed out, leverage gets destroyed, weak hands get forced out, narratives get buried, and then the structural trend resumes without the tourists. That does not happen every time, but it happens often enough that you should never confuse a violent correction with the automatic death of the entire thesis. That is why the recovery off the lows matters. Silver bounced sharply from 72 back toward 85. Gold also recovered meaningfully from its lows. That does not prove a new bull leg has begun, but it does tell you buyers existed where panic sellers were desperate to hit bids. Real money stepped in. And in markets where something is genuinely broken beyond repair, rebounds of that speed and size are usually weaker. Here, the floor showed up fast. Why would buyers appear so quickly? Because for some categories of demand, silver is not optional. If you are a manufacturer, and silver is a small percentage of your end product cost, but essential to production, then price weakness is not merely a chart event. It is a procurement opportunity. The factory does not care about a trader's margin call. The line must keep running. That is one reason physical demand can keep behaving differently from speculative paper positioning. They are not playing the same game. They are not working on the same time horizon. There is also a trust issue buried in this market. When companies begin locking up supply directly, when they move closer to miners or long-term contracts instead of relying entirely on exchanges, that is a statement. It says delivery confidence matters. It says access matters. It says the posted price alone is not enough. That behavior does not show up cleanly on a retail chart, but it can matter more than any single candle. Now, to be fair, there are real risks here. This market absolutely had speculative excess. The run-up was too steep. The participation got too euphoric. A correction was always possible. A stronger dollar can keep pressure on metals. A less friendly policy path can keep sentiment unstable. If global growth slows sharply, some industrial demand could soften at the margin. And if the washout is not fully complete, silver could still see more downside before any larger move resumes. Anyone pretending the path forward is only straight up is not being serious. But those risks do not answer the deeper questions raised by this crash. If this was only a bubble popping, why did the physical premium remain so extreme? If demand truly evaporated, why was the eastern floor so much higher than the western crash price? If silver is just another overhyped trade, why is the strategic policy conversation heating up around critical minerals right now? Why are major institutions placing themselves closer to Asian physical flows instead of farther away? Those are not small questions, and the mainstream discussion has done a poor job of confronting them directly. My view is simple. What broke this week was not silver itself. What broke was the illusion that paper price and physical reality are always saying the same thing. For years, most investors treated those as basically interchangeable. What this crash revealed is that the split may now be much wider than people thought. Paper silver can crash under leverage pressure. Physical silver can still remain stubbornly wanted at the same time. That is the real shock here. Not just the speed of the decline, but what the decline exposed. It exposed that red candles do not necessarily tell the full truth about strategic materials in a world where governments, industry, and sovereign actors are thinking about supply very differently from retail traders. It exposed that wealth in panics does not disappear. It transfers. It moves from those reacting to price alone toward those acting on structure, context, and urgency. So when people ask whether silver is dead, I think they are asking the wrong question. Which silver are we talking about? The leveraged paper version that can get hammered in a margin spiral? That market clearly has deep fragility. But the physical silver that global industry uses, that Asian buyers keep paying a premium for, that critical minerals officials may increasingly treat as strategic, That version looks very much alive, maybe more alive than ever, and that is why this story may just be starting. Because if the emergency meeting leads to language around stockpiling, strategic sourcing, domestic incentives, or tighter control of critical mineral supply, the market will have to reprice what silver actually means. Not as a relic, not as a side trade, but as a material sitting at the crossroads of energy, technology, manufacturing, and national security. That kind of reclassification changes behavior. It changes who buys. It changes how they buy. And it changes how little they care about short-term panic. So watch what happens next. Watch the official language coming out of Washington. Watch whether silver is named directly or indirectly as a strategic concern. Watch whether the Shanghai premium stays elevated even as Western prices stabilize. Watch whether physical tightness keeps asserting itself in places where the screen price says everything should be calm. Because if those signals stay in place, then this crash will not be remembered as the end of the story. It will be remembered as the week the split became impossible to ignore. Was this just a brutal but normal washout after a parabolic run? Or was it the moment the market accidentally revealed how disconnected paper silver has become from physical silver? And one more question. If governments are now treating critical minerals as a strategic priority, do you believe silver is about to be pulled into that category in a much bigger way? If this connected dots for you, subscribe and stay close, because the next moves in this story are not going to be decided by headlines alone. They are going to be decided by policy and physical demand.